Hello, everyone. Matt Somberg, partner and co-founder of Gottfried and Somberg Wealth Management. Hope you're well. Wanted to spend just a few minutes wrapping up the third quarter now that we're in October, reviewing the third quarter and giving you a few things to think about for the rest of the year. Third quarter, not good for stocks and bonds. S&P down 3.3, NASDAQ down 3.9, international down 3.8, bonds down 3.2. First quarter was positive, second quarter was positive, third quarter was down. Pretty much every major asset class across the board was down. On a year-to-date basis, meaning since the start of the year, still have seen some decent gains. The S&P up 12.4, the NASDAQ up 27, international stocks up 2, and the bond market down just a hair on a year-to-date basis as interest rates have risen. In terms of the S&P 500, technically we are still in what's called a bull market. The market bottomed in October of 2022. The market has risen more than 20% since its lows of the fall of 2022, but we have seen a bit of a give back in August and September this year, but still up 20% from the October low. Market still in a bull market. Why? Interest rates have continued to go up. The Fed has been trying to get our economy to cool, trying to get our economy to slow down the rise in inflation, trying to just slow things down in general. And so by raising interest rates, it means that the cost of borrowing money goes up. Cost of borrowing money goes up. Companies are less profitable. They have to pay more interest. Consumers, in theory, should be spending less if they're paying more interest on their loans. And so you can certainly see what's happened here with this relationship. In the third quarter, interest rates have continued to rise. That's the orange line. And the S&P 500 began to fall, which is the blue line there. In terms of the pain that's being felt from the third quarter stock decline, what this slide shows you here is there are 11 sectors that are generally accepted in our economy: technology, healthcare, utilities, real estate, energy. If we take a look at returns on these sectors in the stock market since the start of 2022, 10 out of the 11 are down. So 10 out of 11 sectors have not gotten back to their all-time highs at the end of 2021. Really, the only sector that's performed well over that time is energy, which makes sense because the greatest pain to our economy over the last year and 3 quarters has been inflation, and energy plays a big part of that. For a longer-term investor, if we take a look at the last 5 years, or if you've been invested for the last 5 years, you have 11 out of 11 sectors that are positive. And while energy has done relatively well in the last year and 3 quarters, technology continues to be the long-term winner in terms of the top performing sector out of the 11. Inflation, consumer price index, year-over-year inflation, things are steady. The worst certainly was behind us in the summer of 2022, and we saw a pretty steady fall in terms of year-over-year inflation. A slight tick up higher in August, but still year-over-year inflation is at 3.5%. The Federal Reserve would love to see that get down to closer to 2%, but who knows if that's really possible because we have such a tight job market and labor market right now. The unemployment rate continues to be between 3 and 4%. It is very hard to find labor. Those who have jobs are able to earn more. There's been headlines related to labor unions, for example, which have a lot of strength right now, demanding higher wages and higher compensation. So it's a tight labor market that tends to strengthen the employee, not the employer, and it's very difficult to find labor. With the job market so tight, that does mean that our economy has not slowed as much as the Fed would like it to, and therefore there is the chance that the Fed will continue to raise interest rates. The Fed has come out and said that we will be in a higher for longer environment. That means keeping interest rates higher for a longer period of time. Stocks obviously did not like that in the third quarter, although that was just a 90-day stretch. What this does mean for the non-stock portion of client portfolios is that treasuries, for example, which are bonds that are issued by the United States government, the 6-month treasury, the 1-year treasury are paying approximately 5.4%. Money market funds, which are often comprised of very short-term treasuries inside of it, paying closer to 5.2%. So money market instruments, U.S. government treasuries paying over 5 is the other side of us having been in a rising interest rate environment for the last year and 3 quarters. So sort of wrapping up what's happened in Q3 as we move forward into Q4, There's a lot of year-end planning that's done, tax loss selling, Roth conversions, charitable donations. So a lot more on the financial planning side tends to be done and recommended in Q4. So we'll circle back again in a few weeks to provide you with another update. Hope your fall is going well. And thanks as always for the trust and confidence that you place in our firm. If you have any questions, please do not hesitate to reach out to the advisor in the firm that you communicate with the most. Thanks very much.